How do these private equity investments in subprime work, Jason?
Right. So it's an interesting question, Bonnie, because obviously right before the financial crisis, we saw private equity firms, hedge funds, and other banks getting into these businesses in lots of different ways. In this case, private equity firms are buying the lenders themselves. This is a very profitable business, as you can appreciate, because subprime means higher, people have to pay higher interest rates, and that can be a very profitable business.
Up to 11% in a lot of cases.
That's exactly right. It can be a very profitable business unless the loans don't get paid back. Obviously.
Which is what's happening now in greater and greater numbers. Why the turn suddenly? Why are people suddenly going delinquent, which is 90 days or more not paid?
Well, part of it is just sort of macroeconomic trends. I mean, you showed that chart right there at the top. I mean, it's interesting to see how it did seem like a good business at the time that they were getting in. People were buying more cars. That has slowed down, and so therefore you're sort of left with a lot on the books here. I mean, the other thing that private equity firms, or the firms owned by private equity firms, did, in part driven by their owners, it feels like, is they started extending, payment plans. They started to loosen the terms of these things. They went into what's known as deep subprime, which is even riskier. Private equity is all about risk and reward, and sometimes it doesn't pay off.
Yeah, so some can only blame themselves, Jason, I know, which is the point we're making. How difficult are some of these firms finding it to cash out?
Well, pretty hard so far, Mark. I mean, they are staying in it for the moment. And we should note, I mean, these are not, these are not firms that no one's heard of. I mean, these are some of the biggest names in private equity. This is Blackstone, this is KKR, this is Perella Weinberg, Lee Equity Partners, who have gotten into this business. Our reporters who did a fantastic job on this story talked to a lot of the companies. The sense is that they are sticking with it for now. This is a cyclical business to some extent. As we look into 2018 and think about, what the economy may do if car buying starts to come back, if the economy continues to bump along, this could be a long-term at least non-loser. We'll see if it's a winner or not. I mean, the other interesting element here that I think both of you can appreciate is this is the private equity model to some extent coming back to bite these guys, in the sense that they own companies usually for only 4 to 6 years. So they may have, in many cases, been a little bit more aggressive, Vonnie, in trying to push these companies along to get that profitability so they could sell the companies and make money for their investors.
Are banks taking notice, Jason? Are credit lines being cut to some of these subprime auto lenders?
Well, there is certainly a sense that because of the breadth of this and because of the sort of macro trends, that people are being more a little more hesitant. I mean, the other thing that this story really illustrates, Mark, is how big the sort of non-bank lending sector has become. From a macro perspective as well. We've spent a lot of time here talking to a number of traditional private equity firms who've really extended into the credit business in various ways, and this is certainly an example of that.